My name is Jake, welcome to the channel. In today's video, we're going to talk about dividend investing for newbies. Dividend investing is not a very difficult concept to understand, but it's really important that you understand the basics, and that is exactly what we're going to talk about in today's video. A lot of the videos that I make on YouTube are videos that I wish were around back when I first started learning about dividend investing. I wish I would have come across a video like this 10 years ago. I mean, the thumbnail kind of speaks to me. This is definitely a thumbnail that I would have clicked on 10 years ago. Now, I can't include everything that you would want to know in a single video. Otherwise, this video would be hours long. If there's interest, I'll put together a part 2 in a future video. Now, dividend investing is a great way to invest, but like with anything else in life, you can make mistakes investing into dividend stocks, and things cannot go to plan. And things not going to plan could look a little like this.
Check this out.
Dude, I'm kicking the ball off the side of the house. I gotta bank it off of this first goal into the second goal.
Look at this one.
Scaring my little brother with this confetti cannon. Let's go.
Oh man, the highlight of my week. So I put together 8 things that I would want to include into a video like this, right? If you're a noob to investing, you're a newbie. These are 8 things, 8 chapters, right? Let's stay on theme with the thumbnail. 8 chapters that I would cover in a topic like this. If you're a newbie to dividend investing, these are 8 things that I would want to cover with you. And if there's interest, I'll make a part 2. But I don't plan on it. But if there is interest, I will make a part 2. All right, so let's take a look at it. So chapter 1 of dividend investing for stupid people. What is a dividend? All right, we're gonna come in hot here. What is dividend? What is a dividend? So a dividend is, don't overcomplicate this. It's a cash dividend. If you go and you Google it, you might be confused. It's a dividend or a cash dividend that is paid by a company or a business to shareholders from the earnings of the business. Okay, the business is profitable, they're generating earnings, and part of those earnings, they're paying to you, a shareholder, part of that. So a dividend will trigger a taxable event and is generally going to be paid quarterly, though some companies do pay it monthly. Okay, so it's usually paid quarterly. And remember that dividends are not magic. No matter what somebody says on YouTube, on TikTok, wherever, dividends are not magic. They're not free money. They don't grow on trees, right? It'd be cool if they did, but they don't. Dividends come from real businesses operating in the real world. The dividend is paid from the earnings of the business. If the business doesn't have any earnings, where are they going to pay the dividend from? I guess they could pull an AT&T and shots fired. And they could pull an AT&T and pay with it from debt. But in order to pay a dividend, a company has to be profitable, has to have earnings. Okay, a company can pay a dividend because they are growing their earnings per share. And people often ask if dividends can make you happy. And the answer to this question is yes. Yes, it can. Moving on, chapter 2. Why do companies pay a dividend? Well, generally, you're only going to see late stage or large established companies pay a dividend. The reason for this is that early stage companies like startups, younger, companies that haven't been around for a while are competing for market share. They need all of their capital to capture more of the market before their competitors. Late stage companies that pay a dividend tend to operate in areas of the market that are more predictable, and the company has already captured its targeted amount of its TAM, or total addressable market, right? Look at companies like Meta, like Salesforce, some of these technology companies that are now, after decades, are starting to pay a dividend. And that's just how it works. So it's very, very important that you understand that. The management of every publicly traded company has a fiduciary duty to drive shareholder value. There are many ways that management of a business can drive shareholder value. There's not just one single way. One way is by returning capital to shareholders in the form of a dividend. Companies that are able to not only pay a dividend, but grow their dividend every year are generally rewarded by the market. So how are they rewarded by the market? Well, they're given a higher multiple or higher price to earnings ratio, for example, a higher PE. So the market rewards that, and it is something that not every company is able to do. And so the market does like it. And it also does attract a different type, a different demographic of investor, because once a company starts paying a dividend, some investors, whether it's right or wrong, depends on the individual and their situation, invest into a stock or an ETF solely for the income potential. So it's very, very important to understand that. And companies that pay a dividend require the management team to be mindful of their financial metrics more than companies that do not pay a dividend. Should a company cut its dividend, the stock will likely be punished by the market. So the reverse can happen. If a company is growing its dividend and they reach the status of dividend aristocrat, well, yeah, they're going to reach the status of dividend aristocrat, and they're going to be trading at a higher multiple. Why do you think Coca-Cola trades at like a 25, 26 PE? It's not because they're selling a lot of sugar water. Well, they are, but it's not that they're growing 10, 20% year over year. It's because it's predictable, because they're growing their income year over year. It's also a Warren Buffett stock, so you got the Warren Buffett effect in there as well. But companies are rewarded for paying a growing dividend year over year. What it does is it creates confidence in the business, in the management, and investors are more likely to pay a premium for that confidence. And the reverse happens once a company cuts or suspends its dividend. They're kind of sent to the doghouse. They're not going to be in very good shape. A lot of companies are punished, and in many cases never financially recover from this. Never going to financially recover from this. If you know. And that's just the reality of how it works. Next here is chapter 3. What are the pros of dividend investing? There's a lot of pros and cons with everything in life. A cash dividend or a dividend is real money in your pocket that you can choose what to do with it. You can choose what to do with the capital versus relying on the management of a company to choose what to do with it for you, right? So that's something that a lot of people don't understand, and they always make the case, well, Warren Buffett's Berkshire doesn't pay a dividend, and well, then you shouldn't pay a dividend, right? Because Warren Buffett does it, right? How many times do people quote Warren Buffett and think they're smart, right? Like, it happens a lot, and I'm sure I've done it before as well. I'm guilty of it as well. But it's important to understand that, just because a company doesn't pay a dividend, it doesn't mean that your capital at the business is better off. Enter in, AT&T, for example. Management can make very bad decisions on your behalf. And if the money is in your pocket, well, that's a pro. You get to choose what you do with the money. And the choice can be good or bad. It's all subjective. It depends on you. So that is absolutely a pro of dividend investing. The capital, the real money is in your pocket. Also, companies that pay a dividend are generally seen as more defensive companies with more predictable revenues and cash flows. Dividend-paying companies tend to have less volatility and go down less in a bear market. So if you're a more risk-averse investor, you want less volatility, less beta. Beta is volatility in your portfolio. This is a great way to reduce the volatility and the fluctuations of the market by adding dividend stocks and ETFs to your portfolio. This is absolutely a pro of dividend investing. You can also generate income from your investment instead of selling a share of your stake in the company. A comparison that I always like to make here is with rental properties, right? Real estate. You receive income from your asset without having to sell your asset when it's a rental property. Dividend stocks, dividend ETFs are like rental properties in that sense, where you get to hold the asset and the asset is paying you to hold on to it. So that is absolutely a pro with dividend investing. Moving on to chapter 4, what are the cons of dividend investing? Like with everything in life, nothing is guaranteed. Dividends can be cut or suspended. When a company cuts its dividend, this is generally a sign of major issues at the company. Because dividends are a forced taxable event, the shareholder will be required to pay taxes on the income they receive in the year that they receive it. Not all dividends are taxed the same, and some come with higher tax rates. Because dividend stocks only make up a small percentage of the overall market, if an investor only focuses on dividend stocks, they're really focusing on a small part of the market that tends to grow slower, which can yield, lower total returns over a long period of time. This is one reason why a lot of bogleheads dislike dividend investing, because when you're focusing on dividend stocks and dividend ETFs, you're actively selecting a part of the market instead of owning everything. And so it's very important to understand that dividend stocks, like we talked about earlier, what they are, why a company pays a dividend, is they're in a later stage in their maturity. They're not in hyper growth mode, okay? So you're not going to see that 10x in the share price overnight. These are businesses that have been around for a while. These are businesses that sell toilet paper and tissue paper, something that everybody needs in their day-to-day life. And so it's really, really important to understand what you're investing in and the cons that come with dividend investing. Moving on to chapter 5, let's take a look at some of the important dividend metrics. Now, the dividend yield is usually what newbie dividend investors look at first. The dividend yield is the amount of dividends per share divided by the share price of the stock or the ETF. Because the dividend per share and share price change over time, the yield that you will receive will change over time, whether the company grows it or cuts it. Another one here that is very, very important to understand is the dividend payout ratio. The dividend payout ratio is the percentage of a company's earnings paid to shareholders as a dividend. Now, the key point here is earnings. Now, if you're looking at an unprofitable growth stock, well, when you look at the earnings section, they don't have any earnings. They're negative, right? They might be EBITDA positive, but they're not GAAP profitable. They don't have real earnings, and so they're not going to be paying a dividend, okay? So the dividend payout ratio is really, really important, and because this is focused on newbies, it's important to understand that the dividend payout ratio is just one part of the story, and each sector, industry within the market is going to have different standards or different averages when it comes to the dividend payout ratio. Generally speaking, the higher the payout ratio, the bigger the red flag will be when it comes to the dividend stock. Not always. For example, utilities, sin stocks, certain industries have just generally a higher payout ratio, but just be aware of what the dividend payout ratio is. Another one here is the dividend growth rate. This is the percentage at which a company grows its dividend each year, okay? And you might hear the dividend CAGR, the compound annual growth rate. This is the annualized dividend growth rate of just the dividend. Another one is the dividend yield on cost. Dividend yield on cost is calculated by dividing a stock's current dividend by the price initially paid for the stock. So if you paid, $100 for a stock and you're getting, $3.50 per share, well, your yield on cost is 3.5%. Okay. And if it grows, then it's going to continue to grow. Say it goes up to 4.5, right? Instead of, the company paying $3.50, they're paying $4.50. But your initial cost basis does not change. So your yield on cost went from 3.5% to 4.5%. That's how yield on cost works. It's a great metric to follow, and it's one of the greatest things about dividend investing is calculating your yield on cost, at least in my opinion. The next one here is dividend X dividend date. Investors who purchased a stock on or after the X dividend date will not receive the next scheduled cash dividend. So when you're looking at the stock, you're seeing the X dividend date. If you buy the stock after the X dividend date, you're not going to get the next scheduled dividend. You have to buy it before the X dividend date. And all the bogleheads out there will tell you that the share price will drop exactly 1-for-1 by the amount of the dividend on the X dividend date. And that's the end of it. They don't tell you that it will regrow, it'll grow back and go back again. You know, if you know, good old bogleheads. I love them. The share price drops exactly by the same dollar. Yes, but anyways, don't want to get too far off on a tangent. Chapter 6. Let's take a look at chapter 6. So how dividends are taxed. This is a really important thing to understand. There are two ways a dividend can be taxed, at least here in the United States. I can't speak for every country, but here in the United States, you have qualified and you have non-qualified. A qualified dividend is a dividend that falls under capital gains tax rates, which are lower than income or ordinary tax rates. Think about your W-2, right? This is lower than your W-2 rate. Now, the non-qualified dividend, also known as an ordinary dividend, that does not get taxed as capital gains tax rates because they get taxed as ordinary income. And you want to think about bonds and REITs when it comes to this, or, in many cases, cover call ETFs. This is like your W-2 income, right? There's no tax benefits. You're just taxed at your regular ordinary income rate. There are other tax implications to consider, like international tax. For example, if you're here in the US, you're buying a Canadian stock, a British stock, stock out of Europe or South America, wherever. Just important to understand your international tax rates, as well as return of capital that can impact how your dividend or your distribution is taxed. So very, very important to understand that not all dividend stocks are going to be treated the same when it comes to the tax treatment. So it's just very, very important that you do your research and you understand how your income is going to be taxed. On to chapter 7. Not all dividend stocks are created equal. Generally, you're going to see stocks that have high dividend growth today and low dividend growth later. And the same thing with a higher yield today and a lower yield tomorrow. So these two metrics, the dividend growth and the dividend yield, almost always have an inverse correlation. One will be high and the other low, and vice versa. It's incredibly important to understand that not every single stock is going to have a high yield and a high dividend growth rate. There's a few out there that have a good balance. One of my favorite dividend growth ETFs out there that has a good mix of both is SEHD. SEHD is kind of like a unicorn when it comes to this, and that's why people love to talk about SEHD, is because it has a good balance of both high yield and dividend growth. Now, dividend stocks that have a high starting yield will generally have a low dividend growth rate, and dividend stocks that have a low starting yield will generally have a high dividend growth rate. So the question is, do you want income or growth today, and what do you want in the future? This is where understanding how to invest based off of your investment time horizon becomes so important, and that is why I talk about it so much on my channel. And the last chapter, chapter 8, dividend investing resources. There are a lot of great resources out there. There's some that you can pay for. There's some that are free. A few resources that I really like that I use on a regular basis. I use Seeking Alpha. I think it's a great place for analyzing dividend stocks, dividend ETFs. They have a great ETF and stock screener. You can upload your portfolio. They have a lot of great free and paid services on their site. I use it regularly, literally on a daily basis. Another resource that I really like using is Snowball Analytics. This is a great resource to track your portfolio's progress, your dividend income, everything around your dividend metrics, everything when it comes to the dividend. Snowball Analytics is a great place to track them. Now, they have a free version and a paid version. I would only recommend going with the paid version if you're going to get value out of it. I get value out of it, so I use it, right? So make sure that, if you are going to use a paid service that you are going to get value from it. Otherwise, you'd be better off buying more SHD and DJRO and chilling, right? Like that's my honest opinion. So if you do get value out of it, there's a lot of great stuff. Some great free resources that I use is Portfolio Visualizer. If you watch my videos, I use Portfolio Visualizer all the time. It's a great tool to back test your portfolio. They have a free version. I personally don't pay for it. I don't see the value in it, but maybe you do. I like the free version. Another website that I use on a regular basis is ETF.com. This is a great resource to research ETFs. Everything around ETFs, this is a great free resource. Another free resource that I use is ETFRC.com. It's a great place to check your ETF fund overlap. If you're investing into multiple ETFs and you want to see if there's a lot or a little fund overlap between the two ETFs, this is a great free resource. When it comes to paid content, be very careful what you buy out there. Most investing courses are designed to put your money into the pockets of the people who created the course and nothing more. There's plenty of free content out there where you don't have to pay to learn about this kind of stuff. There's a lot of great free content here on YouTube when it comes to dividend investing. Well, now by watching this video, you have the basic understanding of what dividend investing is. You're no longer a newbie. You now know the basics when it comes to dividend investing. Well, thank you so much for watching, everybody. I hope that the video was helpful. This was a little bit of a different format. I tried to have a little bit of fun with it. If there's interest, I'll make a second part to this video. I don't have anything jotted down. Maybe I make the title Dividend Investing for Less Stupid People. And have some fun with it. I don't know. But yeah, thank you so much for watching, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.